In today's video, we're talking about Roth conversions. When does it make sense to do it? We're going to go over 6 reasons why you may want to do Roth conversions right now. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're trying to bring good retirement information to federal employees and federal retirees. If you need help, click right up here. Today we're talking about tax planning and 6 reasons why you should do a Roth conversion. The number 1 reason is you could be in a higher tax bracket in retirement. Now, for most federal employees, when they retire, your income may go down some, but most of the time it's going to be in the same tax bracket. Most people are either in the 22% bracket, maybe the top of the 22, or they're in the bottom of the 24% bracket. And so when they retire, maybe they move down to the middle of the 22% bracket. One way to rephrase the question, instead of, you could be in a higher tax bracket, you might want to think about it, could taxes be higher in retirement? Maybe technically you stay in the same bracket, but Congress changes all the brackets, for the worse, then taxes could be worse. And so if you think taxes are going to be higher in retirement, then starting to contribute to Roth and doing Roth conversions before that point may be wise. The idea is to pay the taxes when you think tax rates will be the lowest. If you feel that tax rates will be higher in the future, then a Roth conversion makes sense. Now, a second reason to do Roth is that Roth IRAs have no required minimum distributions. A required minimum distribution, or an RMD, is when the IRS makes you start taking distributions from your traditional funds. So whether it's traditional IRA or traditional TSP. And so they've just changed the rules. So the mandatory age is going to be 73 for some people. It's going to be 75 for younger folks. Now, there's a 25% penalty if you don't take your RMD, so the IRS is serious about you having to take it. The penalties aren't really the problem. The problem is being forced to withdraw money that you don't want to. And for a lot of federal employees, they're living off their pension and their Social Security, maybe a spouse's Social Security, where they might not need to take a huge distribution from the TSP or their IRAs. So some of the people we work with, they don't need to take distributions at all. But when they hit the age 73 or age 75, the IRS makes sure that you take some money out. And of course, when you take it out, it's taxable at your tax bracket. Sometimes the required minimum distributions are so large that it can cause you to get bumped up into a higher tax bracket. Now, we're back into the first reason for wanting to do Roth, which is avoiding higher taxes. The great thing about Roth IRAs is that there is no required minimum distribution from Roth. The government doesn't force you to take the money out. They let you keep the money in there to keep accruing interest and growing, hopefully, all with tax-free status. This is a great reason to do Roth. Another reason is tax diversification by using Roth. For many federal employees, they talk about getting ready to retire, and the vast majority of the money is in traditional TSP, meaning it's going to be fully taxable whenever you touch the money to spend it. Now, everybody is aware of diversification and not having all your eggs in one basket. If you think of TSP funds, many people think of diversification, like maybe I'm going to have some money in the L fund that will diversify for me. Maybe I'm going to have some money in the G fund and some of it in the C fund, and maybe some of it in the I fund to diversify. But what about tax diversification? Holding all of your money in one taxable status can lead to problems. If taxes go up, you could be left holding the bag. You must take withdrawals from taxable sources. If that's all you have, then that's what you got to do. So hopefully later in life, you're going to get to take some large distributions on something fun. Maybe you're going to buy a boat, maybe buy an RV, or maybe later in life, you're going to take some large distributions for something that's not fun, like long-term care or medical issues. The problem is taking large withdrawals from taxable sources. If all you have is traditional money and you need to take a large distribution, then that can send you way up the tax bracket. If you've built up Roth IRA, if you've built up Roth TSP, you have a tax-free place that you can go get some money. And if you need to take large distributions, you can do that. Now, you only get to do this if you've diversified your money, tax-wise. So the 4th reason that you might want to do Roth is for estate planning. Roth IRAs are not taxable to your beneficiaries. So they're not taxable to you, they're not taxable to the beneficiary. So we talk about traditional TSP and traditional IRAs. You can postpone taxes. If you, or shall I rephrase it, when you die, the money is going to be left to your beneficiaries, whoever you've chosen. Now, they'll have to pay taxes on that money. The Secure Act, a couple of years ago, changed the rule to where now your heirs only have 10 years to take distributions from the inherited IRA. Now, a spouse has a few more options, but for non-spouse beneficiaries, and I think maybe let's think about leaving it to your children. They're going to have 10 years to spend the money. Leaving somebody traditional money, where they have a limited window of time to access it, can cause higher taxation. But if you leave them a Roth IRA, they still have the 10-year window, but whenever they touch the money, it's not taxable. They may want to leave the money there for 10 full years to keep accruing it tax-free, and then just take a full distribution in year 10, maximizing the tax-freeness of the money. Roth IRA can be very beneficial when leaving money to beneficiaries. Now, another reason that Roth can be wise is if you think that you're potentially going to change your tax filing status. Many of the people that we work with are married couples, getting ready to retire, where one of them is a federal employee. We go through doing Roth conversions, and one of the benefits is that when one person dies, the remaining spouse is now suddenly put on the single tax bracket. The single tax bracket is not nearly as generous as the married filing jointly bracket. And so if you leave a bunch of money to your spouse that's traditional, that requires an RMD, then they must pull it out, and then you've left them at the single tax bracket. It can cause tax rates to be higher. Doing Roth conversions and getting money tax diversified means that if one of you dies, the remaining spouse can take distributions, but they're tax-free. So even though you'll be on the single tax bracket, it won't affect you as much because the money's going to be tax-free. So whether this is through death or through divorce, it might be that you're going to be in the single tax bracket later at some point. Doing some of the planning now and taking advantage of the married filing status can be wise planning. Now, the last reason to do a Roth conversion is time the conversion when the stock market is down. If we have the presumption that markets go down and markets go up, if you can time a Roth conversion when the market is down, getting the money shifted to Roth at a discounted rate, and then have the market bounce back in the Roth account, that can be advantageous. The fact that the stock prices have gone down, it allows you to Roth convert more shares at a lower price, which sets you up to hopefully have an even larger potential gain later when it bounces back, and since it's all in the Roth account, it's all tax-free. So lots of times when we're working with clients, we're getting a copy of their tax return to help determine how much do they need to convert to Roth in this calendar year. One of the things we're looking for is how's the stock market doing? If the stock market's pretty down at certain amounts, we need to time Roth conversions then. Now, sometimes you get all the way to November and the stock market never went down, and then you just have to go ahead and Roth convert at whatever the going stock market rate is. I remember during the COVID times when the stock market just dropped a bunch, it was a great time and we had lots of clients take advantage of Roth conversions at that time. When it bounced back, it was very fortunate for them. One of the great things about Roth is playing the tax bracket game. We're trying to maximize your tax bracket. In the video right here, we're talking about in 2023, the tax brackets. Did they just get lower? If they did, it means it's even better time to Roth convert. So check out this video. My name is Mel Stubbs. If you need help, go to christycapital.com, click Talk to an Advisor. I'll see you on the next video.